Despite President Trump pressuring the Fed to lower interest rates, investors continue to predict the Federal Reserve will keep rates steady. That's because inflation remains persistently high. It's impacted by oil and gas prices from the ongoing war in Iran. But as always, there are all these cross currents that make predicting things very, very difficult. And I must say, if the president would stop threatening tariffs and stop putting new tariffs on other countries, that would also help bring down rates. But he will not do it. Here to talk more about it, former Treasury official and Morning Joe economic analyst Steve Rattner. He joins us now with his charts. And, I never really understood the hatred of Jay Powell and the praising of Kevin Warsh. When you look at Kevin Warsh's past statements, he's always been a hawk. He's always been extraordinarily responsible and always saw inflation as the greatest danger. I don't see that much has changed now that he's in a position of power.
No, I don't think much has changed at all, Joe. In his congressional testimony a week or so ago, he made clear that getting inflation back down to 2% was the Fed's highest priority, and that's part of why this meeting will be particularly interesting. Now, look, the people don't necessarily pay attention every day to the Fed, but the Fed is incredibly important, and what it does with monetary policy represents probably at least half of what makes our economy do well or not so well. But what's happened in the last few months is quite interesting. Some of it has to do with Warsh, some of it has to do, of course, with the war. But you can see that if you go back to the beginning of the year, the Fed and its 12 committee members were expecting rates to continue to come down, and they were pricing in 3 rate cuts, i.e. 3/4 of a percentage point of rate cuts to take the federal funds rate down below 3% for the first time in a very good while. But since the war, that has flipped around. And now people expect rates, in fact, to go up. And indeed, people think, while, as you said in your lead-in, probably rates will stay unchanged, the market has gone from a 10% possibility of a rate increase to a 30% possibility of a rate increase. And as interesting as what the Fed does will be what it says, what Warsh says at his press conference, what the votes are. Traditionally, the Fed operates in a very kind of nonpartisan way, but you do get the sense, and that will be very interesting. But then the Fed expects continued rate increases and not to see rates start to go down until until the middle of 2027 at the earliest, and be above 4% when you get out here to the beginning of 28.
Can I ask a quick question before you go to the chart below?
Sure.
So tariffs obviously have been not only a political issue, they've been a legal issue. The Supreme Court's ruled on them. And Donald Trump says they're not inflationary. Donald Trump says they're not taxes on Americans. But that's not what the Fed thinks, is it?
No, not at all. I mean, I think not just the Fed. Every sensible economist in the world understands that tariffs are inflationary. They raise the cost, not just of what you import, but if you raise the cost of, say, an imported bicycle, then domestic manufacturers of bicycles are also going to raise their prices, because why would they charge less than the price of a foreign imported bicycle? So, yeah, tariffs create inflation. What has obviously also created a lot of inflation is the war. And so you can see that inflation was actually sort of drifting down, and then you had the war and the tariffs, and you can see inflation spiking up here. Inflation has now been above the 2% target for more than 5 years. The Fed, back at the beginning of the year, predicted that inflation would come down to its 2% target, not for a good while, but it would get down there. Then the war started. It said it's going to take longer. Now, as the war drags on, it says it's going to take even longer. So even when you get out to 2029, thanks to the war, thanks to tariffs, inflation is not now projected to be down to 2%. And that's why the Fed is talking about rate increases.
Yeah, and Steve, with all that as the backdrop, let's turn to your next chart, which is on the higher cost of borrowing.
Yeah, so the Federal Reserve only controls short-term interest rates, like what you get on money market funds and things like that. Long-term interest rates are a function of inflation largely. And so you can see here that the 30-year Treasury, our longest Treasury bond, is now up to 5%. It is above 5% for the first time in quite a good while, except for one little blip here. And so that has helped mortgage rates stay up at 6.58%. You can see that. This spread is pretty narrow. You could imagine mortgage rates going even higher. But the other thing to worry about is when you adjust Treasury rates for inflation, what has been happening is that Treasury rates have gone up, adjusted for inflation. And that's a sign that the bond market is quite worried about the state of federal finances.
So, Steve, because of all this, let's turn to the next chart. And this all adds up to what you're basically deemed a growing bill for taxpayers.
Yeah. So why is the Fed worried about the state of federal finances? In large part because of debts and borrowing. So here's what the federal government borrows every year. You can obviously see, go way back when it was borrowing a tiny amount of money. You can see what's been happening. What the several administrations have done is borrow for shorter and shorter periods of time because it's cheaper and it helps make the deficit look smaller. But now that bill is coming home to roost. The government is going to have to borrow $8.3 trillion with a T dollars this year. And that is obviously a huge amount of money relative to anything it's borrowed in the past. Why does it have to borrow all that money? Because, of course, of what I said about the term of treasuries, but also because of the deficit. So Trump, of course, promised to cut the deficit, but in fact, it's going up. It's going to go from $1.8 to $1.9 trillion this year. It's going to stay there. And then, according to the Congressional Budget Office, it's going to continue to climb to $2.5 trillion. This is the highest deficit as a percentage of GDP that we see outside of a recession or a COVID type of crisis. This is an extraordinary level of deficit to be running in a reasonably healthy, low unemployment economy.
All right. Morning Joe economic analyst Steve Rattner. Thank you very much. We appreciate it. Love the charts.